The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, folks, I started the Tiger TV show with the long-term weekly Dow Jones showing the three drive to a top pattern. We've made new highs in the Dow Jones. However, the index that I follow the most religiously, of course, is the NYSE index because it's it's thousands of stocks and they're also cap weighted, and it is just at the 786 of the high from 2009. I know the Dow's the one that's going up, and that's the one they're looking at, but that's a three-drive pattern. And if you look at March 2009, that's it. This is going to be one of the biggest traps ever perpetrated in the stock market, in my opinion. And if it isn't, it's time for the old cowboy to go out into the trails and fish for bass, because that's probably what I'll do. I'll just do my little day trading and try not to figure out what the stock market's doing anymore, because this pattern is ready to go. It's got so much divergence in all the commodities, and it's really amazing. But the main thing we got to focus on today, folks, is the gold market, because we have hit some major stuff, things that we've been waiting for a long time. If we look at the XAU, the gold and silver index, you'll see that today's low was an exact 61% retracement from the low in 2008, and it hit 128.67, and the 618 number was 128.70. So that figure has hit, absolutely perfectly. And then when we take a look at the also the gold bug index, which is a real big one, that also hit the exact number. Also, I've got to be able to do this. I don't know if that gold chart is posting. With someone, anyway, I posted the gold bug index into the chat room, and hold on a second. I've got to make a correction here, and hopefully that'll do it. And we'll see. You can see the gold bug index also hit the exact 0.618 retracement, and this is very important, folks, for a lot of different reasons, and we'll go into those as we go through the show. But the next one that we need to look at, I think is quite important, is the there it is, the GDX, which is the ETF for the gold mining stocks, and that's also a really big one. And oh boy, this is really difficult for me. They made me change something, folks, and it ain't working. So hold on, just give me a second. I'm going to go back to my old way for the time being till I figure out how to use this. This is the GDX, the ETF for the gold mining stocks, and it also hit a perfect 61% retracement. So as long as we hold up above these numbers on these gold stocks and XAU, we've got a real shot here. This is a very, very low-risk buying opportunity in these gold and gold mining stocks. And if the stock market, should be starting a secular bull market, which I do not think it is, these markets could go higher just by being pulled up. They certainly haven't been pulled up for the last, 18 months. So maybe there's going to be a change in the weather, for the gold mining stocks. All I can say is that they hit a whole bunch of numbers, and that's the main thing, that we're watching, as we, look at these particular, instruments, one at a time. Now we also need to take a look at the at the gold stocks themselves, and excuse me, I don't want to do the gold stocks. I want to go to the gold and silver, and what I'm going to do, the best way to see that is I'm going to put up a chart on the goes back almost 3 weeks that shows these higher bottoms that we've been having in the gold and silver. We've been talking about them quite a bit. I know this isn't the commodity show, folks, but this is related to the gold stocks, which are part of the gold silver. Well, they are the gold silver index. So this is what we've had. We've had these higher bottoms forming. This is what was happening with the Japanese yen when it was down around the 75 level. So this is a really critical time that we should be watching the gold. I don't particularly care for silver, but I do like the gold market quite a bit at this level. That one, as long as it holds above the 1560 per ounce level, that's about $17, $18 from where it is right now. It's got a chance for a really significant move, in my opinion. And it's got all the necessary, it got the higher bottoms and everything. So it's really quite important that it actually holds this level here. It's just right at the moment of truth. There's no other. You don't have to risk much. I mean, this is what the whole thing's about, and that's the main thing that what we're trying to do. Now, someone asked a question about the failure that we had in that expanding triangle that we had in the Dow Jones. That, in fact, has done that. It did fail when it went above the 14,200 level. We're now trading at 14,270, and I want to just give you some other information on some of the other markets, because it's just not the Dow Jones that you're dealing with here. You're dealing with things like the New York Stock Exchange Index and the Nasdaq and the S&P, and there's a lot of different patterns, that are happening here. And what one of them that is occurring here with the Nasdaq futures is the fact that we are right at the 786 retracement on the Nasdaq. I don't know which day the final high is going to come in on. Nobody else does either, so it doesn't make that much difference of who actually picks the actual day or anything. But we're also having that same type of pattern that we had in the Dow Jones on Monday. We're having the same pattern occurring now in the Nasdaq. We're having that broadening top pattern is forming on the Nasdaq, but it's coming in at the 786 retracement, just like it is coming in at the NYSE's 786 retracement. So I know the news, Bloomberg, the folks at Bloomberg and CNBC are incredibly bullish, and they're yelling and screaming, and it's St. Patrick's Day early because everything is green. But this is a dangerous time giving these patterns, and these are the patterns that are the best patterns that we have for technical analysis, these three drive patterns and expanding triangle patterns. And they might be off by a couple of days or so, but you're getting very, very close, to something that is, really, really very, very dangerous. The commodity markets are still, going under a great deal of pressure. Copper is still making new lows as we make new highs in the stock market. That's another one that is looking, terribly bad. We'll cover that, of course, on the commodity show tomorrow. And tomorrow I'm going to do my best to have Rich Anderson come on, because we're having a big divergence between old crop and new crop grains, because the new crop grains are dropping and the others are actually holding up. So we'll cover that tomorrow. Hopefully Rich will be on the show tomorrow, and I'll get some information even if he isn't, so we can look at those very, very closely. The VIX index, this is one of the things that I always like to listen to Basil's about, and that is, it's had these big moves. We're having really good volatility in the VIX index, which is, this is ideal for a trading environment. I still think that the double bottom that we made last week is going to hold. We've got some ideas that level of around 12 in the VIX index should hold. So we'll wait and see. But the three drive pattern that we have on the Dow Jones Weekly and the New York Stock Exchange and the Nasdaq, I mean, I've tried several times to get in it. A couple times it worked, really well for a few days, but then again it didn't. But I keep trying, and this is one of the last times I'll be trying, because we've got all the patterns fulfilled now. Even the three drive pattern on the long-term weekly Dow has finally completed, and the New York Stock Exchange Index, like I mentioned before, has only made a 786 retracement, as has the Nasdaq. And of course, one of the big stocks in the Nasdaq is Apple, and we still believe that we're going to be seeing that Apple under $400 a share. My guess is there'll be some kind of a news item that comes out that tells us that the Apple is going, having some type of a production problem or some type of a, it most probably would be a production problem or maybe a marketing problem that a technical problem that, a chip is not working or something that pushes it down, because they know something that's going on in that stock because it doesn't have any friends at all. I mean, that stock had everybody in the whole world wanted it in September, and, well, it wasn't September. It was a lot earlier than that, but I think earlier in the year, and now there's no one that wants the stock. So this is one of the things that, makes the markets go up and down. So this is what we have to, keep an eye on when we're watching these things go up. But don't be bullish here. These patterns are, pattern recognition. If you believe in pattern recognition, these are the things that, you don't want to, stand in front of. If you want to buy something, you want to buy something when it's cheap, and the gold market has held up, incredibly well here. We've had a tremendous amount of support coming into gold. We've shown this, many, many times over the past, several days. The fact is, I'll get to that, and then we'll talk about gold a little bit more when we come to the break. But we held up again just about perfectly to where we thought we were going to do. We had another attempt at the 786 this morning. It came down to that 1567 level, and all we did was we took out the high of the low of the previous day, and then we had to start moving. We need gold to get above $1,600 an ounce for it to really start to move, and any move below 1554 is going to negate any of this bullishness. And and you've got to be very careful here because, as we've said many times, you've had a lot of selling coming into the commodity markets, and believe me, if you remember what happened to this in 2008, this was one of the reasons, why this happened. You should do a little bit of homework here. Let me give you a little homework assignment. Go back to October of 2007 and look at the Dow Jones chart, and look at the NASDAQ chart, and look at the S&P chart. Now, in fact, I'll do that for you when we come back from the break. And you'll see when it makes a new high like that, it really means absolutely nothing. It's just stuff that comes on the TV that they keep talking about because they have something to talk about. And most people are bullish, so that's a positive thing, and that gets the advertisers to come in, and that's what you're looking at. So just be really careful up in here, and we'll see if that's going to happen. Well, it's certainly got the patterns there. There's no question about that. They're all prepared to come in together. Okay, we've got to take a little break here. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, folks, we're back, and I'm going to post into Tiger TV. Oh, dear, no, there we go. I think I can get it in there now. This is the Dow Jones going back to 2007 at the high that we made in October. And as you can see in the circle that I have, you'll notice that there is a series of triangles there. That is the 5-point reverse wave that we have going now. We have wave 1 coming down, then we have a new high, then we have a new low taking out the low of wave 2, and then we have the final new high making the third drive to a top into October of 2007, and that's the exact. Today what we're having is we're having a 3-drive pattern, the same similar type pattern that we had in 2007. I'll just bring that to your attention for what you would like to measure the worth of it. Then the next one I'm going to put in is the NASDAQ going back to 2007, and it was making a ABCD on a 7-month period. The time and price was just about perfect with that one. And remember that the markets broke quite a bit, after that, and then that's the fine one. And then the next one that we're going to look at, of course, is the NASDAQ, the New York Stock Exchange Index in 2007, and you can see that you can also look at that yellow circle there at 2007 in October when we made the final ABCD leg. Up to the the final high. So these patterns are very similar, to what we have happening, right now in the market, and this might be like 2000 where things go crazy, but But frankly, in 1999 and 2000, we were in a lifetime situation of, a mania that, it was very similar to tulip bulbs. In fact, it probably equaled the tulip bulb mania, and also the South Sea Island bubble, the Florida land bubble, and the 1929, stock market crash. That was certainly, those of you that were around remember that. It was, stocks would move 20 and 30% a day, even if earnings dropped. I mean, it was amazing, and we had young kids, 18 years old, making millions of dollars that are, now trying to get a job in out of graduate school, which is, it's very, very difficult. So these patterns have completed before. This is what we're doing, is we're looking at history repeating itself again. I really was surprised when we took out the high of, February 28th. There was a lot of astro timing stuff that was there. We haven't gone much higher, of course, but it did take that high out, and that is, makes me very suspect that there's a possibility that, maybe these patterns will all fail, and things will go up. The $64 question is, in my mind, is what's going to happen when the Federal Reserve tries to unwind, the $3 trillion that they pumped into the bond market, and other things, of course. But we'll see. Remember, this was originally supposed to be a TARP program, Tax Asset Relief Program, with $700 billion. That was the low in 2008 when the market was going down. The politicians scared us that the banks were going to fail, and of course they said, "Oh, they're too big to fail," so they gave them $700 billion. Now you're talking about the Federal Reserve, a private bank, giving into the economy $3 trillion. That's never been done before, so this is a giant experiment, and we'll see it happens. Long-term capital, a big firm back in the 90s, run by John Merriweather, had the same idea. And the problem was is they made money all the time with all their Nobel Prize-winning economists and stuff, except when it came to unwinding their positions. And that's when the problem happened. They went bankrupt. It took the Federal Reserve to come in and save I think they paid 5 cents on the dollar for it. And it was very cheap, I know that. And the rest was history. So we are at a critical time here in these markets, and it's really quite amazing. I'm surprised that the bond market has held up as well as it has. It's had a little bit of a correction here from the high, and but it's still held up relatively well, considering that the stock market has backed off as much as it has. So we'll keep an eye. And when we come back from the break at the bottom of the hour, we will talk more about the bond market and what we see there. And then, we also need to, really stretch the importance of where we are in the gold and silver markets, because they're right there. I mean, they really are. Okay, we got to take a break, folks. 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and we have a call from John in Philadelphia. Are you there, John?
Hello, Larry. Good day to you, sir.
Good day to you, my friend. What can I do for you today?
Hey, Larry, thank you very much for pointing out that phenomena that you're seeing in the HUI, the GDX, and the XAU, the mining indices. My question is this. First, an observation. I will observe that both gold and mining equities, the indices, let's talk the GDX or the HUI, for example, they both made lows on severe sell-offs on that Wednesday, February 20th, and then they bounced a bit. Now, gold bounced up higher and has subsequently come back down but not taken out that Feb 20th low. I think that was 1555 or so. And, of course, the GDX, the HUI, the XAU all got progressively weaker, made new lows, and then we have this feature today. My question, I want to ask if you could elaborate on what you could speculate, what could possibly happen with the XAU and the HUI if in fact gold itself fails to lift.
Then these stocks are going to go lower because, if they can't rally with the rest of the stock market just by being a magnet. I mean, people just like to buy things cheap, and they're not going up, and so they got to stop right here, or they're dead. That's the way I see it. I mean, every one of these things hit the exact number today. The GLD hit it exactly. The gold has already made the numbers. Now we've had a perfect 618 in the HUI. We have a perfect 61% retracement in the XAU. I mean, this is it. They bounced off the bottoms today, and that's a good sign. So to me, they've got to hold these levels, otherwise they're no good.
Just buy them here and place your stops just underneath those lows, eh?
Low today, yeah, the low today. That's all you got to do is, in my opinion. I posted into Tiger TV just now a weekly gold bug index, and it shows the pattern that I'm talking about in the NASDAQ, in the Dow Jones, and in the NASDAQ. It's in the NASDAQ also, and it's also in the SPY. It's at that expanding 1, 3, 4, 5, expanding reverse point wave, and it shows that, it called the top of that gold bug index, in August, very nicely, and that's just the same pattern that we're looking at now in stocks, and, that's all I'm looking at, It's pretty much same thing, that you're looking at, is my opinion. But it's got a hold today. I mean, this thing has been down for, I think, 20 weeks in a row. In other words, the gold bug index has been down for 20 weeks in a row, which makes it, an outlier event. So that's a pretty negative thing.
Terrific, Larry. Listen, that answers my question, and I appreciate the elaboration.
Well, we'll see what happens. It's just a number, but if we start, if gold breaks below the 1560 level, John, or 1554. I don't see how these gold stocks and silver stocks are going to hold up, because that means you're going to be looking at lower metal prices, and they've had a hard time holding up on anything. They haven't had any friends at all. All I'm looking at is this is just a beautiful 61% retracement. Technically, it's perfect in everything, so it doesn't get any clearer in my book.
Indeed.
I mean, they're lined up right. Whether they work or not, I don't know.
Exactly right.
The good part is nobody else does either.
No, indeed. Excellent. Larry, thanks so much for your time. I do appreciate it.
It's my pleasure. Always enjoy talking to you, John. Thank you.
All right, Larry.
Okay, now, folks, we're going to take a look at I'm going to get the notes up here. I'm going to put the weekly note chart up so we can take a look at where we are, because we've had a nice bottom form at the 61% retracement about 4 weeks ago, and we had a nice little rally for 3 weeks, and now we've given almost all of that back, and we're almost ready to go below 130 in the Treasury notes. And if we do that, I really believe that we are going to see an acceleration in interest rates, and that's probably going to be the thing that's going to scare some people, would be my guess. The bond market is at least 3 times or more bigger than the stock markets, probably 6 times bigger when you look at it on a global basis. But that's something that I think is, extremely, important to look at. Now, when you look at the long-term, bond chart, on the weeklies, and we've said these things have completed, for a long time now, and our expectation was going to be that we were going to get a potential for a rally coming in to about the 150 level in the Treasury bonds, which would complete a beautiful head and shoulders pattern, on the long-term weekly. But, we hit that 61% retracement 3 weeks ago, and we've gone nowhere. We rallied, a total of 4.5 points in bonds, which is, virtually nothing, and we've given 3 of those points back. So, that's not a good sign, in itself. So that's another reason that, I'm getting more and more bearish, on the bonds and on the notes, because they are certainly, looking like they want to go lower. They're just not rallying, and when they don't rally, they only have one other way to go. And remember, the whole world has been looking at yield. They've been searching and trying to find yield, and they've made these things like high yield bonds and stuff like that, almost like investment grade bonds, and they are far from that. And these are things that cause panics in the markets, is when you get too many people on one side of the market, and it doesn't react that way. Then it makes it makes it more difficult to to get these things going. I'm going to do a long-term weekly on the high-grade bonds, so you can see. I don't have very good data here because just one second here. I'll refresh this. Maybe this will help. Yeah, this helps a little bit. And you can see that the high yield, this is junk that I'm going to be putting in here. When you see high yield, that's another word of of calling it junk. And we've had a pretty good rally in this. In other words, rates have been dropping. But look at the swings that have happened in between 2008 and 2009. They gave up 50% of their value, and that's another thing that when these interest rates start to move, they can really move very, very quickly without anybody worrying about it all. There was one other stock one other chart that I wanted to share that one of our TFNN listeners happened to email me. It came from Bloomberg News, and basically what it is, it's the chart of the gold mining index, the GDX, and it's related to Apple. Now, there's got to be about a correlation between the gold mining index and Apple. It's got to be close to zero. I mean, I don't see how they could. But if you look at the chart, since April of last year, there's been a high correlation between the GDX and Apple. And, believe me, that there's not any gold mining stocks in the Apple iPads and stuff like that, and I don't think it has any gold or silver, in the product itself. But the correlation for this period of time, 1 year, is, quite high. I don't know what the cycle is that's running it, but, you can see that there is a very high correlation just during this period. Now, if we're correct and the gold is going to hold this level, then we've got a chance, for it to go. But believe me, this is still early in the day, and believe me, gold can move $15, $20 in a matter of seconds, and that can make it, really, really a big thing to, really to look at. So that's the main thing that we were watching that in gold. They just have to hold the 1560 to 1555, 1555 to 1560 level is the critical level, in the gold market, and that's the main thing that we want to look at. Now, I want to share something. Since we don't have any callers, I wanted to share some trading tips that what you go through as a trader. I think this is something that you all have an interest in, because I've been watching the Australian dollar for several days, because we were waiting for this 3 drive to a bottom pattern to form that I put into Tiger TV, and we were looking at the Australian dollar to come in at the 101 level. It had some beautiful symmetry. There were 3 separate AB equals CD patterns that told us that the market was heading towards that 101 level, much like the same thing that we're looking at in Apple, where we think we're going to at least 394 in Apple. So all that was happening. The problem is that it happened at 2 o'clock in the morning, and it only hit the price, the exact price, twice. And unfortunately, was unable to get a fill. And by the time, this is an hourly chart, by the time I had, got to the machine, it was about 3 hours later, the market already moved $400 or $500, so that increased the risk by about $500, and I didn't want to take that, and so I said, well, I'll buy a pullback. And as you can see from the chart, it did not pull back. It just kept moving and moving and moving and going higher and higher, and it didn't give you a chance to, really come in and, get anywhere near the price that you wanted when you were really trying to do it. That's part of the problem that you have is when you're trading, is that you've got to be able to, stand there and say, okay, this is what I've got to do, is to, pick my best spots where I don't have to risk very much, and that's what we're looking at. That's what we have going on now in these gold stocks and the other things that we're looking at here. We have some really good things that are holding up, incredibly well. Now, I want to shift gears here because we need to talk about the currencies, because we're at such, really critical levels. We are forming a really massive head and shoulders pattern in the U.S. dollar index. We've been talking about that for quite a while, up at this 83 level. We are at 82.54, so it means we've got a little bit more to go to the downside. But if this market is really strong and we can clear above 84, in the dollar, then the dollar is going to be on a run that is going to be just, it'll be really, really fast, I think, and, go a great, great deal higher. And the reason for that is from April of 2011 until September of 2012, we were only able to make a 50% retracement, and that would set up an ABCD up around the 90 level in the U.S. dollar. So the 83 area is going to be very, very critical. We've been in a very strong run here ever since we talked about that 79 level. Many, many weeks ago, we showed the support that was there, and so this is what we're looking at when we're looking at this U.S. dollar, because it certainly has a great deal of support and momentum heading in that direction. The next one that we need to talk about, of course, is the Japanese yen, because we've had very little corrections in the yen here. The most we've been able to get here. I'm going to put it up on a weekly basis because we can see it a little bit better. But we were able to correct just about 3 points. That was the only correction that we've had so far in the dollar versus the yen. And we're really close to this target that we're looking at 95 change. We're only 200 pips away, and we could make that within a few days or hours. The way these markets jump around. So that's the main thing. I've had a request to take a look at the small cap index, the IWM, and I'll put that up here. And I'm just by glancing at it, I see that we're attempting at the old high again. We haven't quite made it yet, but we have made a double top. It looks like right now. It looks like it's actually down on the day-to-day, which is sort of surprising because the Dow is up. But the IWM has completed the very large ABCD pattern on the daily basis. I will do one on the weekly too, just to double check where we are there. And oh my goodness, you're not going to, this is Mother God and country. You'll see here in just a second here. If I can get this corrected, we will show you the same pattern that we have in the Dow Jones and the same pattern that we have in the S&P. And it's that same pattern. It's that butterfly pattern, that 3 drive. It's just another one that's saying, be very, very careful. If you take a look at this IWM, go back and look at the last time you had this pattern. You go back and look in April of 2011, it went from 87 to 60. And then when the bottom was made, it made the same bottom at 60, and now it's making the same pattern at the top. So, if you buy here, you got to put a stop in somewhere because this thing could really, come unglued, to the downside. So you've got to be, just extremely, extremely careful at this level. But that's what I see in the IWM. It might make a new high, it might not. It's a double top type thing, and all these patterns are complete. Now, if they go higher from here, we got to take a little break and then wind up the show. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
And we are approaching, I put up a 15-minute chart on gold, and we had the $20 rally, and now we're pulling back into the support zone of 1573 to 1570. But remember, it's that 1560 is the key point. If we go below that, then there's going to be some, serious problems. Right now, all of the gold stocks are holding up. The gold indexes, the HUI and the XAU are holding up well. I want to mention here a little bit about the overall market. I believe the problem is not going to be with the stock market. The problem is going to come from the bond market, and the reason for that is this has been a credit bubble all along. If you remember in '96 when Greenspan first released the credit thing and they started the rates down towards zero, where they've been for many years now, they've made credit available very easily. When you used to buy a house a few years ago, you could just walk in and say, I want to buy a house, and they would give you usually 125%, so you could fix it up really nicely. They didn't really care. Now if you go in for a mortgage, you have to go through a body search. They search cavities. They do everything. I mean, they look at every possible nook and cranny. And not everyone can get a mortgage now. It's not as easy as it once was. And so this is where the problem is when they come to the door for the bond market and they try to get out, that door is not going to be wide enough, and there's going to be some really wild gyrations in the interest rate market. This is a 32-year cycle that's ending. It's had that big butterfly pattern. Doesn't appear like we're going to make the head and shoulders like we wanted, but if we go below 140 in those bonds and 130 in the notes, they're going to turn the lights out, and it's going to be very, very nasty to the downside. And as you know, they don't take any prisoners. when they start to, liquidate, because they've already liquidated whoever they happen to be. But this is going to be the problem. This is how these markets, get overextended. This is what happened in 2007 when we had the credit bubble, and we've got the same. The Fed did nothing, didn't really do anything any different than what the banks did. They just made credit available to the banks at a very cheap price, zero, hoping to stimulate the economy. It stimulated the stock market, but it hasn't stimulated the economy to that extent as of yet. And if it starts to unwind, that's going to be, the problem. I'm bringing this to your attention because I'm looking at the charts, and I can see that this could very easily be the culprit here, is the bond market, could be the one that, is going down on the Titanic, and it throws a life raft up to the stock market, and it doesn't have much air in it, and then there's where the problem could lie. So you've got to be very careful, up in here. These people that have been clamoring for yields, have been buying high-grade bonds and getting them up to the quality of, the AAA, ratings of the notes and bonds of the U.S. government. That's where the problem is. We've got a lot of markets that are making these types of tops, and you have to be able to, really pay attention to it. So there's a lot of things that are going on, of course. Tomorrow on the Commodity Report, pretty much we should have Rich Anderson on. That's it, folks. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.